Today, folks, we are going to enact a holy sin on this channel by talking about covered call ETFs. In fact, I got 3 for you I would consider buying as a percentage of a portfolio that wanted more income, perhaps somebody in retirement, but we have to dispel and talk about the myths of this industry, because in the realm of influencer clowns on this platform, you have dividend investors and you got income investors, and I'm here to tell you, we are but the same thing. Companies generate cash flow at which they'll either reinvest the cash flow themselves or they'll pay that cash flow out as a dividend. Typically, more mature companies that have more built out business models that don't have a lot of growth ahead of them will likely pay higher yields to their investors. And typically in recessions, if you are holding a very recession-proof business, it's nice to collect that cash flow that you can either spend or reinvest in a down market. But obviously over a 20-year period, markets always go up over time. Like, the markets have always gone up and no one's ever lost money over 20 years. So in this 15-year pronounced bull cycle, unlike any time in history, you have to say, hey, it's likely this is probably going to keep going if history has anything to say about it. And you want to build a portfolio that captures both sides of the market, regardless of what kind of investor you are, because that is just generally intelligent. It's like common damn sense. And any financial advisor with 2 cents in their head is going to tell you the same thing. But I get, if you're in retirement, you might want a bit more income, but you still can't shy away from growth. And if you're younger, you might want those companies that are better at reinvesting the dividends or the cash flow they're generating than paying it out, because I'm going to get a better rate of return from a company like Google, say investing in self-driving. But when it comes to covered calls, this isn't even a conversation, because we're not really talking about business, are we? We're talking about a very active investment strategy that requires writing contracts at given strike prices to a buyer, that if the stock I'm holding gets to that given strike price, they have the right to buy those shares or call them away from me. This is a very detrimental strategy toward a growth market, which we've been in for quite some time. And generally, you want to be very careful about the stocks you're writing covered calls against, because I see people chasing highly volatile companies with covered call strategies. And though you might say the premiums are a lot better, some of these ETFs yielding up to 80%, you have to recognize that yes, the buyer of those contracts is willing to pay a higher premium on a higher volatile stock, because it's more likely that that stock's going to go up dramatically over time. And as an investor, it seems kind of foolish, because the reality is we're not trying to cash flow a highly volatile stock. We're trying to capture the upside. And why would we want to give that upside away to collect a smaller premium? It doesn't make a lot of sense. Now, covered calls do make sense in flatlining and down markets, which we know are rare at this point, but the reality is they still come about, and the right covered call strategy can still do very well in a nice trickling to the upside market, but they can reduce some volatility, and that's how some people might define risk. Some people think risk is the volatility of the market, and it can be absolutely if stocks are doing 50, 60, 70% mood swings, and it's nice in not, again, highly volatile stocks to write covered call strategies against, but you can't compare covered calls to something like bonds. They're very different investment vehicles, and you need to compare the underlying assets of what you're holding versus maybe just owning those underlying assets outright. Now, I'm not going to ramble any longer. If you're on a path to financial independence, if one day you want to retire early, you want to build out a well-diverse portfolio of intelligence, and you're going to listen to a finfluencer clown like me, for the love of God, hit that subscribe button, folks, and let's get right into this. Now, you have to recognize that you are literally giving somebody a massive fee to write covered calls against some underlying assets. You need to understand the underlying assets, the exposure you have. There's leverage that's being introduced to some of these ETFs. They're very complicated vehicles for the average investor, which is why I typically don't recommend them, because most of them, let's be real, don't have a track record. And as somebody that wants stability out of their portfolio and reliability, you need some form of a track record. Typically, my bare minimum is at least 10 years. And I'm telling you, that is incredibly hard to find, because this is still a relatively new industry. But if you look at any of the ETFs and covered calls that have been around for a decade, they don't look as appealing, because they don't have they just show what happens to covered calls, which is there's a highly volatile dividend payouts, because you're collecting a premium. You're not really collecting a dividend, really. It's just cash someone's willing to pay to hold a contract. And that can fluctuate dramatically depending on market periods. And that's why I really wouldn't even look at this if I was a younger investor. And I wouldn't even look at this if I was reinvesting dividends. This is a strategy where if you're going to enact it, you want to be utilizing the capital today. And I have nothing against making this like a 10% 20% part of one's portfolio if you want to generate some quick cash flow today. But it can be very detrimental over the long term, which is why it's so important not to make this a huge position or make this your entire investment strategy. Because I promise you, I know you see a lot of investors out there touting about their 20-50% yields, but they're not really touting about their total returns, because anybody could buy like a blind ETF and severely outperform these ETFs. But DIVO comes up on my list, and this is one that I would highly recommend because it's been around for a very long time. It meets my requirements of having a very low expense ratio, 0.56%. And if we just take a look at it, basically there's income potential comprised of high quality dividend oriented stocks along with covered calls on individual stocks. And it seeks to lower volatility with dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So basically this is kind of a defensive play as basically defined here to seek that lower volatility. But what I like is that it's not chasing some crazy covered call strategy. And currently the distribution rate, including the covered calls and the dividends, is only 4.78%, which to some people out there might not be that much, but I always want to iterate that you need to look at the total returns. Because if you look at the total returns, if we scroll down a little farther here before looking at the holdings, we can see that the year to date has been 11.33%, but it's actually been higher than that because this is as of June 30th, 2025, guys. We need some updates here because June 30th of 2025, which, I mean, when was that? May, June, where's 30th? Right there, right? So we've seen some substantial upside since then, like 4%, 5% just in equity growth, excluding the monthly payments that come out in that time period. So this ETF has crushed it. It's outpaced the S&P 500, and it holds great companies like Caterpillar, Apple, RTX, American Express, nothing making up more than 5%. You got JP Morgan in here, mostly diversified in financials and some information and technology. I think this is a great combination to get US exposure, especially in a Canadian retirement account, but also just generate a bit more cash flow, right? But you still have to recognize it doesn't matter what covered call ETF it is. In periods of extreme volatility, when your stocks get called away, all this stuff can happen, and it can lead to incredible volatility of the income itself, which is something that I don't really understand why this is considered passive, stable investing in retirement. I mean, the dividends can be just absolutely incredibly volatile, as we see with DIVO here. I mean, there's years, and look at always the yearly payments, which you're not going to see because most of these haven't existed for much longer than a year. But at least DIVO's got some backstory here, and we can see there's periods where the premiums have gone massive to where they've been down a lot, and they're kind of all over the place, right? But that's just the reality of this style of investing. But this is why I always say look at the total returns, because there's nothing wrong with taking profits off a company like this sometime down the road if you want to buy a car or do whatever, which is something I always find interesting that covered call investors have such a hard time doing, is just hitting a sell button when the markets are doing well and taking like 1% of their portfolio to spend. But meanwhile, they don't mind that their underlying stocks can get called away, and then they have to completely repivot. And the guys managing this, could you imagine just watching the people actually writing the covered calls? Some guy coming to the office every day and managing this, and then the guy behind the guy saying, look at my passive strategy of this man that sits here and manages writing my covered calls every day. I think it's hilarious. But regardless, we can look at something like HMAX. I do like the Canadian banks a lot. I really love Canadian bank stocks. And I think owning them outright is probably going to do your portfolio leaps and bounds over owning something like this. But I really recognize that if you do want to bump the income up on your portfolio for somebody that's looking to spend it, this ETF can definitely help out. It's got a little bit of a track record going back to 2023. Basically, there's about a 12.8% yield on this, and it diversifies beyond single stocks with exposure to Canada's largest financials, flexible coverage ratio adjusted to achieve target yield and preserve upside, active covered call strategy managed by option team with 50 years of experience. Again, I don't ever hear covered call investors even talking about the people that are actually writing these strategies, let alone if they even have any track record toward doing so. As a good fit for investors who want a diversified exposure to Canada's 10 largest financials with approximately 70% exposure to the 6 big banks, it's tax efficient distributions, reduced volatility, which we know we get from option investment strategies, and the fund objective is designed for attractive monthly income while providing exposure to market cap weighted portfolio of Canadian financial services. I do love the saying of market cap weighted. Regardless, if we do take a look down here, and you can see this does not use leverage, which I would prefer. I don't pertainably like the adding of leverage to try and make up for the upside, which in most bull markets will do great. But trust me, the bull markets are escalators up and the bear markets are elevators down. And if you have any major levered exposure, whew, baby, you capture all the downside, but limit your upside, man. It can be a very detrimental strategy if you're not careful. These are can be highly risky investment vehicles if you don't know what you're doing. But if we take a look at the since inception, returns have been 13.6%, which is actually higher than the distribution payout, which is great. Year to date, up 16.78% as of September 30th. Even better, nice to see it. And yeah, you can see there's Royal Bank in here, heavily levered though. Again, this is why I wouldn't make these massive positions, because Royal Bank makes up 23% of the entirety of this ETF. So kind of similar to VDY, you are upper weighting the best performers, but that's why you want to be very careful about how big of a position these are, because you might be misappropriating your over allocation to certain stocks. Regardless, this is still what I think could be a great ETF and something that I would never have against buying. And we only have a couple years of dividends here, so nothing too crazy, but pretty consistent overall, around $2 annually. If we actually take a look at the dividend history on a monthly basis, we can see year to date, or let's just take a look at the 1 year here. We can see that the dividend payouts have actually been slowly trickling to the downside, not by a material amount, but again, this is the problem. You're not getting that dividend growth, right? You're just getting these massive payments up front from the premiums. Again, great for people that want income to spend today. I do not recommend, again, this strategy for people that want to reinvest the dividends. It's a foolish game that will underperform. Hamilton Enhanced U.S. Covered Call ETF. Now, this is a newer one. Uses a little bit of leverage, and it gives you more exposure to the US. And the reason I'm kind of divvying these between a variety of different covered call ETFs is because you want to diversify your holdings even through these ETFs, so you're not concentrating in any one given sector. And this one, again, it's got a little bit of history behind it going back to 2022. Not too much history, but this one's a little different, right? So we've got 12.7% distribution yield, getting paid monthly, writing covered calls with overall sector broadly similar to the S&P 500. It is Canadian hedged, and it's also available to purchase in US. A higher yielding alternative to the S&P 500. It does have a little bit of modest 25% cash leverage, and the fund seeks to provide attractive monthly income and long-term capital appreciation from a diversified multiple sector portfolio of primarily covered call ETFs, primarily focused to the US. So this is an ETF of ETFs. Since inception, it's only returned about 9%. It's only been around since 2022. It's not actually the best rate of return comparably to even the broader markets, but still fairly reasonable returns for someone looking for income, not really keeping up with the distribution yield, but you're getting basically a covered call ETF of covered call ETFs, really diversifying the heck out of your exposure. Again, you're paying fees on this, which I didn't really look at the HMAX fee here. Did we overstep the fees? What are the fees on this guy? Can we see here real quick? The covered call, typically flexible coverage. I want to make sure we are well aware of the fees, guys. Where are the fees here? 0.65%. So this one definitely falls within the line of the realm of not overcharging. If you get over 1%, guys, it kind of gets ludicrous in my opinion, like to pay an over % fee where it seems nuts to me. Like I wouldn't mind paying a financial advisor to manage my portfolio for 1%, but putting it into a covered call ETF where these get up to like 2% in some cases is just ludicrous. Could you imagine paying a guy just 2%? I mean, yeah, he's writing all the covered calls, but this comes back to the point of if you've got $1 million portfolio and you're paying a guy 2%, that's 20 grand. Come on, like if you're gonna sit here and talk about it on YouTube every day, why not just write the covered calls yourself? Prove you know what you're talking about, right? Regardless, this one says that it has a 0% management fee, but you got to recognize the fees are in the underlying assets here. But this one, I might dabble in just to get some diversity. But my two major picks would be DIVO and HMAX, because if we look at the Hamilton one here, the HYLD, you can see the dividends again fluctuate year over year. They're not very stable. They can be up some years, down some years. But again, to lock in a really high starting yield for those that are looking for cash flow today, probably, again, something that I might consider looking at. If we take a look at the 1 year, however, we do see some 13, 12 monthly distributions up to 14, up to 15, doing pretty good, right? A little bit of history here. Again, I still think they're highly risky, and you need to look at them with a very cautious eye and very much so take the time to educate yourself on what you're doing with these, because I'm seeing too many dumb investors don't understand what they're talking about, really loading the boat on these things and detrimenting an entire community toward thinking this is a stable retirement idea of some case, yet younger investors think it's like a dividend snowball, like somehow they're building out, like, again, that's another really weird thing, this dividend snowball. Like, why are people trying to build out dividend stocks and reinvest the dividends in stocks that just generally underperform the market? Like there's nothing saying that you can't, if you're not going to use the dividends today, forget the dividend snowball. Focus on the companies you're buying. Again, I just don't understand why people have such a hard time so analyzing the yield and not talking about the underlying asset. Like, do you not care about the stocks you're buying? Do you not care about owning Apple or Google, understanding their business models, their moats, where they're going, making sure you're getting exposure to the best possible markets, the best growth, knowing that right now global markets are outperforming and getting some exposure to China and Europe? That's what I mean. I'm trying to do is just continue to build out a nice diverse portfolio, but with a lot of aspect on technology, because technology continues to propel, but you can't buy tech-oriented covered call ETFs because it's going to limit your upside on what you're trying to capture when you're buying those. It completely defeats the purpose, in my opinion. Now, obviously, I'm a hater. I'm not a total hater. My parents own some of these ETFs in their retirement. I have nothing against them. I just have something against stupidity, which is really built out in the finfluencer clown world. But I'll pass the question off to you. I'd love to know what you think about all of this in that comment section below.